So number one, as I said before, you cannot write the check, right? The trustee has to. So you have to give the trustee the money so they can write the check for the policy.
Yes.
Okay. So this trust has to have its own bank account.
Yes.
So it receives, and usually these are set up where the premium is due annually. So once a year, the premium gets paid. So there's an interesting story behind this. And there's a family, I think back in the 60s, called the Crummey family.
Okay.
It's MN, not MM. So it's not Crummey as in crumbs. It's Crumney.
Okay.
Right? So Crummey.
Okay.
And so this family, wealthy family, hired some very smart lawyers. And they came up with this idea because if I give somebody money and then they do that, the IRS looks at that and says, this is a sham transaction.
Right.
You know, yeah, right. You just gave them money. They're buying the premium. This is all to get around the whatevers, right?
Of course, yeah.
So what they said was, but wait. What if the way that I can prove that this was not for the purpose of paying a premium is that I have to make it a completed gift.
Okay.
Meaning that the beneficiaries of this life insurance trust, my kids, in this case, the Crummey family's kids, have to have, for a moment, the right to take that money out of the trust and go buy a Ferrari with it or whatever they want to do.
Okay.
They have to own it for one moment. And if they own it for that moment, then you can't say, because they could, kids are unpredictable, right?
Yeah,
they may say, what the heck with the life insurance? I want that money.
Yeah.
Right?
Yeah.
So they can do that. So how do we make the money that you give to the trust for the benefit of your 3 children, let's say, into a completed gift?
Okay.
And this is what the Crummey family came up with. So what happens is the gift arrives, and you just made the gift. So let's say it's $20,000. So you give, or 3 kids, $21,000. So you made a gift of $21,000 to the trust. The trustee now notifies the 3 kids. They're beneficiaries of this trust.
Right.
Guess what, kids? Your parents just made a $21,000 gift. You're each entitled to $7,000 of that. Do you want the money?
Okay.
And then the kids go, and they have 30 days in which they can say yes or no. Now, after the 30 days, they have to respond in writing that, no, I do not want the money.
Right.
So once they don't want the money anymore, the trustee goes, okay, what do I do with this money? I got this $21,000 burning a hole in my pocket. And so they pay the premium.
Okay.
And so because it was a completed gift to the kids,
right.
So it's very important that they're called Crummey letters.
Yeah.
These letters were invented by the Crummey family, so they're called Crummey letters. And there's a whole process that you go through. It takes 30 days. And the reason why the 30 days is because kids can come up with all kinds of reasons why they want that money in 30 days, right? So you got to give them time.
Yep.
You can't they get the money and that very second, no, I don't want it. Then you want to make it actually realistic that the kids have the opportunity to take that money and do something else with it, and the premium is not the guaranteed thing that this is for.
A reasonable amount of time.
30 days.
Yeah.
So once that happens, now the 3 tests, 3 tests, are met by the trust.
Yeah.
The trustee paid the premium. The trustee has the incidence of ownership, and the trust is the named owner.
Yep.
And now the value of that policy is outside of the estate.
Wow.
Yeah. So now, as I was talking about before, you could have a situation where somebody is, you want to do it. The perfect way to do that whole ILIT is to buy a brand new policy.
Yes.
But in circumstances where somebody's health does not allow for that,
yes,
then what you want to do is move your existing policies into the ILIT so as to have them escape from estate tax. And as I said, there's a 3-year rule for that. So you have to sit tight and not die for 3 years.
Yeah.
That's my assignment. That's what you tell people. Your assignment is not to die in the next 3 years, because then you're going to screw up the whole plan.
Yeah,
we don't want that to happen.
Yeah, that'd be a lot of paperwork. It'd be super annoying.
Now, the ILIT can be designed to be a dynasty trust, which we talked about in a previous podcast, meaning that the proceeds of that life insurance policy are now in the dynasty trust for, in this example, the 3 kids.
Yes.
They each have their own separate dynasty trust.
Right.
And ladies and gentlemen, if you don't know what a dynasty trust is, we're not getting into it here. Go watch the podcast on how to protect your the inheritance for up to 100 years, and we'll explain it in detail there. But basically, the proceeds could be hermetically sealed in this ILIT, which converts into a dynasty trust.
Wow.
And can be protected for them from lawsuits, divorce, estate taxes, bankruptcy for potentially 100 years.
Yeah.
So work this all together, and it can be a pretty terrific thing. So again, what's our disclosure?
You should talk to a professional, your professional. We'd be happy to sit down and talk to you about any planning, but before you take any action, please talk to someone that does this for a living.
Yes, we're not lawyers, but one thing we can do is give you enough knowledge that when you are talking to your lawyer, that you know the questions to ask, and you know generally what you want to get done, and you're not running up the legal fee clock on the learning curve.
You talk like an auctioneer.
Have you ever noticed that when you're talking to a lawyer, they always want to joke around with you? And I'm thinking, this is costing, every single second of this is costing me money. Let's cut to the chase here.
Yeah. Get down to business. Come on.